Hello and welcome to World Insight with me, Tian Wei, coming to you live from Beijing on CGTN. It's probably the biggest offshoot of the simmering trade war between China and the United States, the falling value of the Chinese yuan. The currency, some say, may be the battleground now after the initial U.S. tariffs on Chinese goods. It could be just the beginning. U.S. President Donald Trump says he is ready to go all the way on tariffs, his latest threat against China in a trade between the world's two biggest economies. It would amount to a tariff on virtually all China's exports to the United States. Take a look.
The trade war escalates. Mr. Trump says he's out to hit China with duties on $500 billion worth of exports to the United States, almost the entire value of Chinese exports to the country.
I'm ready to go to 500. I'm doing this to do the right thing for our country. We have been ripped off by China for a long time.
Mr. Trump wants to raise duties on Chinese imports in retaliation for what he called unfair Chinese trade practices, which has widened the U.S. trade deficit with China. His administration says the deficits harm the economy, even if it posted the best sustained growth in years. China denied the U.S. claims, hitting back in kind with equivalent duties on some of the most valuable American exports, including soybeans and automobiles.
China is the biggest consumer market for the U.S. companies Apple and General Motors. Qualcomm Incorporated gets 58% of its revenue from sales in China. If China exports clothing worth $450 US to the U.S., the Chinese company earns 5% profit, while the U.S. side earns 84%.
China and the U.S. have yet to resume trade negotiations, while U.S. retailers warn consumers will ultimately bear the brunt of higher prices. Meanwhile, G20 members have sought dialogues to defuse trade tensions, as Mr. Trump's America First policy not only alienated China, but also its traditional allies such as the European Union, Canada, and Mexico. Finance ministers and central bankers from the 20 countries warned that heightened trade and geopolitical tensions threaten economic expansion and that the G20 could not afford a disruption over trade disputes. Economists warn the situation could easily turn from bad to worse, a cause for worry over the future of international trade.
For more discussion about the currency issue amid China-U.S. trade war tensions, we are joined in our Beijing studio, Mr. Hong Hao, who is the Managing Director and also Head of Research from the Bank of Communication International. Welcome, sir, to our program. Good to have you here in Beijing. And also in Beijing joining us, we have Einar Tangen, our current affairs commentator. Welcome, sir. Joining us from Washington in the U.S., we invited Adam Posen, the president of the Peterson Institute. What a pleasure to have you, Mr. Posen. Thank you so much for being with us. Let me start by asking about the RMB. Mr. Hong, help us to understand, as a research head of one of the most important Chinese banks, what exactly is it that we see some devaluation of Chinese RMB over the past few weeks since the trade war apparently started?
Yeah, well, I think in part it's a reflection of this synchronization of different monetary policy pursuit between countries. The U.S. Fed is obviously tightening, but then at the same time, the Chinese PBOC is actually loosening, easing monetary policy in response to some economic slowdown domestically. So there is indeed a divergence of choice of monetary policy between the two countries.
I see.
So as you can see, you know, there's the gap, the U.S. and Chinese interest rate gap is actually widening. So I think in part it reflects in the Chinese currency's weakness.
Some suggest it's about 8% over the past few weeks. Of course, it seems like a big number, but when you look at the severity of the potential if the trade relationship between China and the United States goes worse, that is likely to be a big negative impact on all currencies around the world. Certainly China, one of the largest economies in the world. Mr. Posen, your thought?
Yeah, I completely agree with you. This is a lose-lose for both economies. As we at the Peterson Institute have been warning, and you and I have spoken about before, Tian, the Trump administration, the president seems to genuinely want to harm China rather than settle trade disputes, and that's a terrible route to go. The important thing, as your colleague already discussed, is that the currency is moving down for multiple reasons, not due to Chinese manipulation. In fact, when the U.S. attacks another country with tariffs, generally their currency goes down against the dollar. We've seen this repeatedly with Mexico over the last couple of years. So Trump will not be able to deliver a weak dollar at the same time he's putting on tariffs.
Well, at the same time, Mr. Hong, I did notice over the past few days, particularly during the weekend, both the Chinese Securities and Banking Regulatory Commissions put out new regulations, and yet none of these regulations about wealth management products are as strict as many expected before. How would you interpret that? How is that related to what is going on right now with the RMB and the overall economic situation, Mr. Hong?
Yeah, well, I think it's a tactical response to what's going on in the Chinese economy. I mean, obviously, because the leveraging campaign is going on really well. I think the domestic credit growth is actually decelerating rapidly. So in a way, because of the deceleration of credit growth, it actually creates some pressure on the Chinese economy. So if we continue to pursue unfettered, with the original speed, with our deleveraging campaign, with our new rules in our asset management industry, I think the Chinese economy would be under sort of a tremendous pressure. So I think, in a way, we're slowing down the process a little bit, to give some leeway for the Chinese, especially the wealth management industry, to breathe.
If, Mr. Poulsen, you are asked as to what are some of the sectors you would, as a real scholar in economics, look at when it comes to the real impact of this trade war on the Chinese economy, what are some of the two top choices you would mention?
Well, you've already mentioned how the government is trying to offset the big first-round effect, which is what we would call a demand shock. People losing confidence, investment being reduced. There's some amount of people saving rather than consuming because they're scared. And so you usually offset that by loosening monetary policy or spending fiscal policy. There are better ways to do it than letting wealth management products go, but that's another story. The second thing you look at is the localized effect in various areas of China, just as you would in the U.S. When there are tariffs on bourbon, it hits Kentucky. When there are tariffs on Harley-Davidson, it hits Wisconsin. Similarly in China, if there was a decision against ZTE, that would hit Shenzhen region. So you look at the specific industries and the specific locations where there's likely to be a rise in unemployment. And then the third thing you would look at is the profitability of certain businesses going forward. Are you going to have a temporary interruption, or do they have to reassign, rethink their relationships? You mentioned Qualcomm. There are a bunch of other suppliers that go back and forth in the electronics industry.
Right.
If this is temporary, they don't need to change much. But if it's lasting, they may need to change their plans.
Mr. Hong, of course, Mr. Poulsen mentioned several sectors. That is what is likely to be the direct impact on some of the industrial sectors. But what about on the monetary and fiscal policies, particularly in the United States, if I could ask you the other way around, Mr. Hong? For example, recently you see President Trump coming from the U.S. certainly trying to make an impact on what the Fed's policy should be like. Of course, the Fed should not necessarily be directed by an acting president. So, Mr. Hong, what do you make of this latest development and the reactions coming from the Fed? As a Chinese economist, how are you interpreting all of these?
Yeah, I think Mr. Trump is trying to put his finger onto just about anything. So I think the U.S. Fed has been independent, remaining independent for a long time. I think it's a valuable sort of a characteristic of the U.S. Fed. So I would say that by putting on, if he really push forward, with his tariff imposition on all of the Chinese exports, then I think inevitably the U.S. inflation pressure will rise. And I think that would put the Fed into a bind and force the Fed to raise interest rate substantially faster than anticipated. And I don't think that would be a good situation for the U.S. economy or for the rest of the world.
Mr. Paulson, though, the Fed is thinking about raising interest rates, isn't it?
Yeah. I mean, I think there's a legitimate debate whether they need to raise rates quite as quickly as they plan. As was just said, I think the Fed ultimately cares more about the inflation rate than anything the president says. The risk is more the opposite, that the president, by attacking the Fed in this way on rate hikes, makes it harder for the Fed to stop or to pause, because then they need to show it's clear in the data and not because they're giving into public pressure. So as with the exchange rate, President Trump is going to end up causing the opposite of what he wants by pursuing these kinds of policies.
Mr. Trump has rebuked the Federal Reserve for raising interest rates with a strong dollar. With the dollar-fueled global trade, though, U.S. exchange rate risks are very mitigated. Transactions are smoother, the liquidity of the currency increases. The U.S. government can finance, some say, its deficits at extremely low cost, and U.S. firms get easier access to capital. The dollar accounts for about 64%, ladies and gentlemen, of the world's reserve currencies. So 1/3 of the global GDP is generated by countries that fix their currencies to the U.S. dollar, and it's in 85% of foreign exchange trading. Look at that number. What does that mean, Mr. Paulson, when it comes to real benefits the U.S. is likely to get and has been enjoying over the past few decades, since the U.S. dollar is one of the most important currency Federal Reserve currencies, rather, in the world?
Yeah, I mean, it's been a win-win, because there's an advantage to having one currency that everybody invoices in and that puts reserves in. It just makes everything much more efficient. But the U.S. clearly has had advantages. It's generally tended to keep interest rates down in the U.S. because so many people hold dollars. It's been a deal. The U.S. doesn't behave irrationally and is open, and as a result, the U.S. issues the main currency. Now, over time, as China grows, as the U.S. shrinks relative to the rest of the world, that has to change. But it's going to be a lumpy change, because there's a cost to setting up alternatives. I don't mean alternative currencies, but everyone billing or everyone putting their reserves in. Now, the Chinese People's Bank did put out an effort a couple of years ago to make it easier for foreign central banks and other big investors to hold Chinese renminbi as a form of reserve as opposed to dollar. It's only been taken up a little bit, but I would expect that to increase in coming years.
What does that mean when the U.S. dollar, Mr. Hong, is really, as we all know, the major reserve currencies in the world? And therefore, what does it mean for China when it comes to the impact of an apparent trade war?
Yeah, well, I think, as you indicated just now, the U.S. dollar is, 64% of the global reserve system. And so I think many countries are forced to hold U.S. dollars. And I think in so doing, it actually pushed the U.S. long yield down. So the U.S. Treasury yield is, was at a very low level prior to its recent surge. So I would say that it takes time to sort of change the existing system, and I think because the existing system is so entrenched, even though the PBOC has been using some creative ways, for example, pricing the gas contract with the Russia supply, in Chinese yuan and all that, and also pricing some petrol in Chinese yuan and traded in the Shanghai Commodity Exchange. But those are sort of incremental change right now.
That's
and
right.
I think it takes time to challenge the existing system.
Now, Mr. Paulson, here's the thing. We all remember the Asian financial crisis. At that time, China eventually stood out as a very responsible country, responsible economy, also responsible currency. But the thing is, when it comes to bilateral trade wars, how responsible the U.S. will be, how responsible the policies coming from the Trump administration will be, and how responsible when the war really happens, will that transform its whole process into eventually a currency war, which is really the biggest danger ever people are going to face. Mr. Poulsen.
Well, I actually think that in some ways other things are bigger dangers than the currency war. And yes, China played a hugely constructive role in 1997-98 by keeping their currency stable. And China played a hugely irresponsible role from 2004 to 2008, intervening massively to weaken their currency. Right now, China's not manipulating, and the U.S. is at least threatening through President Trump to be a bit more irresponsible. But ultimately, there are all these forces pushing up on the value of the dollar. The high growth rate, in part thanks to the tax cuts, the natural effect of when we put tariffs on other countries, including China, their currencies go down, the fact that economically, when you start messing, the trade deficit doesn't change, so the currency has to adjust. And then finally, the fact that we're running such big deficits puts up pressure on interest rates and inflation, so that also pushes up the currency. So President Trump may want a currency war, but he's not going to be able to win one. He's not even going to be able to wage one. He's just going to get frustrated.
Very interesting, that analysis. A lot of knowledge over there about the basic principles of economy. Having said that, though, it's not just finance and economics. It is also geopolitical, some suggest. Mr. Tangen, you see the G20 finance meeting is taking place right now as we speak, and therefore people are talking about the risk, but people are also hoping there will be ways to prevent the risks.
Well, in the communique, they made it very clear that this is a matter of urgency. The language is much stronger than their last meeting. And Christine Lagarde made it very clear. She said 0.5% could be the effect on world growth.
That's
but
right.
she did not include the latest information, which was the 500 million.
500 billion, rather.
500 billion that Trump is threatening. So there's huge, massive repercussions to this. This is not China versus the U.S. Remember, there are so many countries who are going through China, part of the global supply chain. This is going to hurt them. And ironically, it's going to hurt American companies probably the most.
That's true. So what about that America First policy? America First, many wonder, has already become America alone. Mr. Poulsen, whether we like it or not, but that's what seems to be the ideology President Trump is holding very dearly. What does it mean now when it comes to other apparatus of the U.S. government about their preparedness for the worst scenario?
Well, I agree with you completely, and I and many others, Americans, have been saying America First is a terrible name for a policy. It harkens back to some of the worst ideas in the 1930s in the U.S., and it is America alone. And there are various other ways in which the U.S. can mess itself up and mess up the global system. I like what the previous speaker said about the fact that this is hurting other countries and other economies, even though it hurts the U.S. a lot. I think you move to a world in which third countries, smaller countries, get more bullied if you move to a world where the U.S. is being so short-sighted. And that's not a good outcome for investment. That's not a good outcome for freedom.
But what are the other branches of government likely to do? Is there any hint?
Well, remember, the U.S. branches of government are not well coordinated. Right now, the Congress has been busily accepting whatever the president does. We may finally see a limit on that once the costs of the tariffs start to be felt. The courts, particularly with court cases brought by individual state governments within the U.S., could interfere. There are independent agencies, not just the Fed. But you do have things like the USTR, and Commerce can do special investigations of particular companies. You do have issues of what we call extraterritoriality, the U.S. trying to impose its rules on people who use the U.S. banking system. That comes up more in things like sanctions on Iran or North Korea, but it could be used as a way of bullying people. There are risks, but there are limits too.
Well, there are different analyses, Mr. Tangen. It seems about the recent threat coming from the U.S. president toward China in a TV interview. Some say it's too much pressure for him politically at home because of the fallout of the Helsinki summit. We all remember that, his failure of pushing forward the denuclearization process of the Korean Peninsula after the Singapore summit, his immigration policy together with his election tactics. All of these seem to drag him down to a certain extent, and therefore he has to use the trade as a bargaining chip with his domestic constituencies. Having said that, though, what do you make, Mr. Tangen, of the ways and the reasons why he is threatening about 500B? Of course, none of us could really interpret that, but help us to understand what could be the eternal, shall we say, collaboration among different factors, whether China and the United States be able to turn back the clock or at least to hold on to what is right.
Well, there's an interesting quote by Jamie Dimon,
J.P. Morgan.
J.P. Morgan, he said, Donald Trump is getting the wrong advice from his people. And he means his close advisors, the Navarros and the Lighthisers and things like that, who said that China would not fight back, that there would be no retaliation. So they're doubling down. They've advised him that he has to go at it hard. The harder he goes, China will give up.
But having said that, though, you see various members of the administration, including so-called the Dove, like Mnuchin, who is the Treasury Secretary, at least termed by some, also talking about the 500B. Of course, you could say, well, it has to be a united front in a certain extent because of the whole administration. You also see Kudlow, you know, after he's trying to name the name, he has been even saying, well, you know, our trade policy against China is going to continue, not just for the midterm elections, leading up all the way to the general presidential election. So you see one threat after another coming from the administration. The rhetoric are getting ever intense and higher. What are they looking at? Is this almost at the end of their possibilities of making a threat, Mr. Hong?
Well, I mean, what more can they do? You know, 500 billion is all that they're importing from China. All right, so, you know, they're trying to put tariff on all Chinese exports, but then at the same time, you know, they discover that, you know, as the rhetoric getting more intense, you know, they're actually winning more support from the constituency. And also they're winning, you know, the left, right, and center of the U.S. Congress as well. So, you know, I would say that, yeah, he is probably getting wrong advice. But, you know, I think as they progress, they quickly would discover that the limit to the trade war, you know, because in the trade war nobody wins. And also, you know, after all the tariff put in on all Chinese exports, what more can they do?
There are a lot of states who's likely to speak up, I guess, as a result of that. Mr. Polson, before we go, final words from you. Your analysis, what is your version of this?
No, I very much agree with your other guests. I think, but in particular, don't pay attention to the advisors and all these day-to-day stories about what this one says and who's a hawk and who's a dove.
Yes.
President
That's
Trump
what they want us to do, right? To follow them day by day.
View.
Right, Mr. Polson?
Right, exactly.
That's rhetoric war.
I think, unfortunately, I agree. And so I think the thing is, we're only going to see this end when the costs to the U.S. are sufficiently bad that the Congress stands up and limits the president. And that's what we have to hope for.
All right. Thank you so much, Adam Polson, Einar Tangen, last but not least, Hong Hao. Thank you so much, gentlemen, for sharing with us your real insights. Really appreciate it.